one of the way to raise capital is through crowdfunding. So what is crowdfunding? Crowdfunding is a exercise of funding a project or business by raising small amounts of money from large number of people. It normally can be done through the internet. It's a form of crowdsourcing. It's an alternative finance. And how does this work? So it provides a forum to anyone with an idea to pitch in front of waiting investors. So it has created an opportunity to entrepreneurs to raise a lot of money to invest. And crowdfunding can be done through several websites in Malaysia. For example, these are the websites. Last but not least, there are advantages and disadvantages of crowdfunding. So the advantages are it's a fast way to raise finance, and then it's a valuable form of marketing because it's done through online, and you're able to get feedback from the experts to how to improve your ideas. As for the disadvantages, definitely takes a lot of time and effort, and project creators are afraid to lose their ideas because it's not safe. And industry is becoming more diverse and complex with new support and services because IT has been increasing day by day. So it is difficult.
What is bootstrapping? Bootstrapping means starting a business without external help or capital, which means you use your own money to start up a business. So bootstrapping a company might seem like a risky proposition. Nearly every startup was a bootstrap at some point. Investing some of your money will usually make investors and lenders more willing to partner with you down the line. So the more you can bootstrap in the beginning to achieve good market validation, the easier you're going to find your path to raising capital. So there's second thing is about the pros and cons. So the pros of bootstrapping are funds can be easily accessed because you're using your own money, and you will be more responsible because it's your money. So you'll be more responsible. Little or no obstacles, flexible interest rates. And the cons will be bootstrapping doesn't work for large businesses. It only works for small scale enterprise, lack of investor support, and personal risk. So there was a saying from Brent Gleason. He's a leadership and team building coach specializing in organizational transformation. He says that if you believe in your own vision and have an absolute refusal to accept failure as an option, you should feel comfortable investing your own money into the business.
Now, I'm going to explain about one of the way to increase the capital of the business, which is apply for loan. As everyone know, loan is a liability, which we can get it from bank or any other financial institution. Traditional financial products remain the primary way small businesses fund their operations. However, there are a lot of new technologies and new ways to increase the capitals. Okay, there are some requirements to approve the loan. The requirements are as below. You have to be in the business for 2 or more years. The next one is the business must have a strong annual revenue, typically at least 100,000. Annual revenue means income per year. And the next one is good credit. A business credit score is the measure of a business creditworthiness, which is made up from a number of factors to understand the financial position of business and its level of financial risk. The score ranges from 0 to 100, with 0 representing a high risk and 100 representing a low risk. Moving on to the next slide. Before apply for loan, we need to prepare some documents like statement of profit or loss. Statement of profit or loss contains the income of the company or loss of the company based on the financial year. Okay. The second one is balance sheet. A balance sheet also a financial position of a company, which include asset, liability, and equity of the company. The next is tax return. A tax return is a tax authority that reports income, expenses, and other tax information. And last one is bank statement.
Another way a company can increase their capital is by asking friends and family. This way is frequently used by startup companies to raise initial capital. Why you can ask funds from them? Because they believe in you and your ability to execute the business plan. So, all you need to do is to get over the awkward feelings of asking for help and convince them that you are serious about the business. The advantage of asking funds from friends and family is funds can be easily accessed and flexible. Besides, They may lend funds with free interest rate or lower interest rate than the bank and agree to a longer repayment period. The disadvantage of asking funds from them is this arrangement can damage relationship between the lender and the borrower sometimes. So moving on to next, the tips to raise capital from them is firstly, you have to build a business plan and have a contract with them. Next, don't ask for more than your friends and family can afford to lose. Lastly, focus on well-connected friends with relevant business experience.
Way a company can increase their capital is by finding an angel investor. Angel investors are accredited individuals with a net worth exceeding 1 million or annual income of more than 200,000. They operate alone but may also team up with other angel investors and create a fund. Why do companies require angel investors? Fast-growing small companies usually need aid overcoming funding gaps to sustain their growth. Angel investors can support companies by sharing contacts and networks to secure additional capital. Angel investors networks in Malaysia invest varying amounts as compared to venture capital. Angel investor networks usually invest anywhere between 50,000 to 2 million or more, where early stage venture capital only invests from 500,000 to 1 million. So where do we find angel investors in Malaysia? Angel investors can be found in angel investment groups or networks. Example are Nexia. Nexia ensures that both the startups and investors are a good fit before the introduction takes place.
Venture capitalist. Venture capital funding is becoming a very famous and even becoming a very essential source for raise capital. Venture capital actually is a form of private equity and type of financing that investors provide to startup companies and small businesses that believe to have a long-term growth potential. Example, venture capital funding comes from well-off investors, investment banks and other financial institutions. There are two main advantages by getting investment from venture capital. With venture capital funding, a company can acquire large sum of capital that would not be possible through bank loans or other conventional methods. Secondly, venture capital provide expertise and industry connection that are extremely valuable. If a company wants to get investment from venture capital funding, they must submit proper business plan. Thus, venture capital funding one of attempt kickstart up a company to raise capital.
Company can raise its capital by issuing shares and bonds. Company can either issue common stock or preferred stock. Common stocks represents ownership of the company. The common stockholder have right to vote for the board of directors who actually manage the company and vote on corporation policies. Company does not need to make obligatory interest payments to investors and instead can make discretionary dividend payments when it has extra cash. Although issuing more common stocks diminish the voting influence of existing shareholders. For preferred stockholders, company need to give them fixed percentage of dividend each year, but they do not have right to vote for the board of directors. On the other hand, issuing preferred stock is often seen as a sign that business has a lot of debt. Finally, bond, which is a loan to a company that pays investors a fixed rate of return over a specific time frame. Company can reduce the tax expense by issuing bond, and the cost of issuing bond is cheaper than cost of issuing stock. Bond has some disadvantages too, like it's riskier compared to alternatives, and the fixed interest expense.